Imagine investing in a stock, sitting back and simply watching your bank account grow as regular dividend payments roll in. Sounds pretty perfect, right? But before you get excited and dive headfirst into the world of dividend investing, there are some important things you should know first and some pitfalls that you don't want to fall into. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. Are you wondering why you haven't received dividends despite your investment? Why have others received monthly dividend payouts while you're still waiting for yours? Are dividends basically free money? Let's get to the basics. What exactly is a dividend? A dividend is a portion of a company's profits distributed to its shareholders, as essentially thought of as a reward for their investment. When a company does well and earns a profit, it has a few choices. It can choose to reinvest that money back into the business to try to grow the business. It can buy back some of the shares from the shareholders. It can leave it as cash for later. Or it can distribute some of the profits to shareholders. This distribution is known as a dividend. If the company is not doing very well, then it doesn't have these same options and won't be distributing dividends. Or if it does, they won't be doing it for very long. Dividends are most commonly paid in cash, where shareholders receive a payment directly into their brokerage account, investment platform, or even into their bank accounts if they set it up that way. On rare occasions, companies might also issue dividends in the form of additional shares of a stock, which increases the number of shares a shareholder owns, but for now we'll focus on cash dividends. Dividends are typically paid out on a regular schedule, such as monthly, quarterly, semi-annually, or annually, but we'll cover each of these later in more detail later in the video. The decision to pay a dividend and the amount to be paid is made by the company's board of directors. This decision is based on various factors, including the company's profitability, cash flow, and overall financial health. Sometimes companies may also issue special dividends, which are one-time payments made in addition to regular dividend, often when the company has had particularly strong earnings or maybe sold off some segment of their business and they wanted to distribute the proceeds. For investors, regular and dependable dividends are an obvious or tangible sign of a company's financial stability and profitability. Companies that consistently pay dividends are often viewed as stable and reliable investments because regular dividend payments suggest the company is generating enough profit to reward its shareholders while still maintaining and growing its operations. How do dividends work? Imagine you and some friends decide to plant an apple tree together. You all chip in some money to buy the tree, fertilizers and tools to take care of it. When the apple tree starts producing apples, everyone gets a share of the fruit based on how much they contributed. If you contributed more to help grow the tree, then you get more apples when it finally produces them. Now think of a company as the apple tree and the shareholders as the friends who put in the money. When the company makes a profit, just like the apple tree producing apples, it decides to share some of that profit with the shareholders. So dividends are a portion of the company's profits given to shareholders for investing in the company. The more shares you own, the bigger your share of the dividend. If you own 40% of the whole company, then you should get 40% of the dividend. Usually for the bigger companies, it's easier to think about in terms of dividend per share. So for example, right now Coca-Cola pays out $1.94. If you have one share, then that's what you'll get. If you have two shares, then you'll get $3.88, and so on and so forth. What is dividend yield? The dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's a way for investors to measure how much they're earning from dividends compared to the price of the stock. Here's how you calculate it. Dividend yield equals annual dividends per share divided by price per share times 100. To understand dividend yield, let's look at an example with a company called ABC Inc. ABC Inc. pays $3 in dividends each year for every share of the stock. If the stock price is $60, you can calculate the dividend yield by dividing the annual dividend, $3, by the stock price, $60, and then multiplying by 100 to get a percentage. So 3 divided by 60 times 100 equals 5%. This means that if you invest $100 in ABC Inc. stock, you'll earn $5 in dividends each year. The dividend yield shows how much money you can make from dividends compared to the stock price, giving you an idea of the income you can expect from your investment. Why is dividend yield important? A higher dividend yield might seem attractive because it suggests you get more in money back in dividends for each dollar you invest in the stock. However, a high dividend yield can also be a warning sign. It might mean that the company's stock price has dropped, which increases the yield, potentially indicating problems with the company's business. Therefore, while a high dividend yield can be good, also you have to consider the company's overall financial health and whether it can sustain its dividend payments over time. Payment schedule. It's important to know that dividend stocks have different payment schedules to each other. With proper and precise scheduling, this can lead you to your goal sooner than you expected. These payments can provide income streams that can help you build a financial foundation. Here are some of the most common payment schedules that you're likely to find. Monthly dividends. Some companies opt to pay dividends every month. This monthly payout schedule can provide a consistent and predictable income stream, making it particularly attractive to investors who rely on dividend income for their living expenses, or who prefer more frequent reinvestment of their dividends. Quarterly dividends. The most common dividend payment schedule is quarterly, where dividends are paid out 4 times a year. Many established companies, particularly in the United States, follow this schedule. Quarterly dividends align well with the company earnings reports, allowing companies to base dividend payments on recent financial performance. For investors, quarterly dividends provide a balance between frequent income and administrative simplicity. Semi-annual dividends. Some companies, particularly those based in the UK, pay dividends twice a year. These are usually a final and interim dividend. While less frequent than monthly or quarterly payments, semi-annual dividends still offer regular income to shareholders. Annual dividends. A few companies choose to pay dividends only once per year. This annual payout schedule is less common and is typically seen in regions or sectors where businesses prefer to distribute dividends after assessing their full year performance. These are mostly found in Europe. For investors, annual dividends require more patience but can be often larger due to the accumulation of profits over the entire year. Key dates for dividend payments. As a beginner, you may be wondering why you didn't qualify to receive a dividend even though you invested beforehand. Maybe you bought the stock at the wrong time and missed the crucial date. To be eligible for dividends, you need to own the stock before the ex-dividend date, which is the cut-off date set by the company. If you purchase the stock on or after this date, you'll not receive the next dividend payment. To qualify for a dividend payment, investors must be aware of several key dates. Declaration date. This is the date on which the company announces its intention to pay a dividend. This announcement includes the amount of the dividend, when the ex-dividend date will be, and when the payment date will be. Ex-dividend date. This is the cut-off date established by the company. If you purchase the stock on or after the ex-dividend date, you'll not receive the next dividend payment. To qualify for the dividend, you must own the stock before the ex-dividend date. Record date. The date on which the company reviews its books to determine who the shareholders of record are. Only shareholders recorded on this date will receive the dividend. Payment date. The date on which the dividend is actually paid out to us shareholders. Let's make an example for us to understand it clearly. Declaration date. On June 1st, XYZ Corp announces that it will pay a dividend of $1 per share. The announcement includes the following details. Ex-dividend date will be on the June the 14th. Record date will be on June the 15th. And the payment date will be on June the 30th. 2. Ex-dividend date. The ex-dividend date, as we saw, was on the June the 14th. If you want to receive the dividend, you must purchase shares of XYZ Corp before this date. If you buy the stock on or after June 14th, you'll not be eligible for the $1 dividend. Record date. The record date is June 15th. On this day, XYZ Corp will review its books to determine which shareholders are entitled to receive the dividend. If you were a shareholder as of the end of trading on June 13th, the day before the ex-dividend date, your name will be on the record and you'll receive the dividend. 4. Payment date. The payment date is June 30th. This is the date when XYZ Corp will actually distribute the $1 dividend to the shareholders of record. Example scenario. Investor A purchases shares of XYZ Corp on June 10th. Since this purchase is before the ex-dividend date, Investor A is eligible for the dividend. Investor A's name will be on the record as of June 15th, and they'll receive the $1 dividend per share on June 30th. Investor B, however, purchases shares of XYZ Corp on June 14th. Because this purchase is on the ex-dividend date, Investor B will not be eligible for the dividend. They bought the stock too late to be on the record as of June 15th, and will not receive the $1 dividend on June 30th. How to buy dividend stocks. It's all well and good to find out about dividend stocks, but you need to actually know how to buy them too. If you're from UK or Europe, then the most popular broker amongst our dividend community right now, and also the broker I recommend for the majority of use cases, is Trading 212. It's quite user-friendly, and I made a step-by-step user guide on how to use it in this other video. I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. If you've opened a new account recently or planning to open an account, then here it is. DivExp or DIVEXP, short for Dividend Experiment. So you have up to 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, many thanks, and thanks to Trading212 for sponsoring this video too. Why do companies cut dividends? There are times when a company might decide to cut or reduce dividends. This can be worrying for investors, not to mention it's important to understand why it happens. Reasons for cutting dividends. Financial difficulties. If a company is experiencing financial trouble or its profits are lower than expected, it might cut dividends to save money. This helps the company hold on to more of its cash, which can be crucial for staying afloat during tough times. Reinvestment needs. Sometimes companies see opportunities to grow and expand their business. To take advantage of these opportunities, they might choose to reinvest their profits back into the company instead of paying out dividends. This reinvestment can fund new projects, research, or expansions that could still benefit the company in the long run. Economic conditions. During periods of economic downturn or recession, companies often face a challenging environment. To navigate these tough times and ensure they remain financially stable, companies might reduce their dividend payments. Debt reduction. Companies sometimes carry a significant amount of debt. By cutting dividends, they can use the saved money to pay down their debt. This helps strengthen their balance sheet, making the company more financially secure. Why it matters to investors. When a company cuts its dividends, it can be a warning sign or a red flag, indicating potential financial trouble. For investors, this means it's important to closely monitor the reasons behind any dividend changes. Understanding your company's overall financial health can help you make informed decisions about your investments. If a company cuts dividends due to growth opportunities, it might actually be a positive sign, showing the company is focused on long-term success. However, if the cut is due to financial distress, it could be a signal to reassess the investment. Why should you avoid dividend cutters? The chart here shows how different dividend policies are related to portfolio performance. Companies that grow or start paying dividends reach the highest portfolio value in this comparison, indicating strong growth potential. This chart clearly shows that dividend policy is correlated with performance, generally speaking. Companies in a strong enough position to initiate and grow their dividends will generally perform better. Of course, you can't always tell if a company is going to cut their dividends, but the chart shows the importance of at least trying to avoid companies that are likely to go down this path. Conclusion. Dividend investing can be a rewarding strategy, providing a steady income stream and potential for long-term growth. Now, you should have a basic understanding of dividends, how they work, how much you are likely to be paid out and when. Then, finally, we look to the importance of avoiding stocks that cut their dividends. If you think there's something missing from this explanation, you're welcome to leave it in the comments below, or check to see if I have a video on that topic already. There are loads of them in the video library at this point. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!